Morning, everyone. Welcome to another REV Real Estate Live webinar. I'm Jim Hodges. I'm going to be the host today. We had to excuse Dallin. He's actually being interviewed in a podcast right now and couldn't make this. So he asked if I could host today. So thank you for coming. We always appreciate you guys showing up and contributing to our cause here of educating the masses on all things real estate investing. And today our topic is differences between general partners and limited partners. So I don't have a little magic whiteboard behind me, so I'm going to be doing this via a PowerPoint presentation. And please, at any time, feel free to jump in, unmute yourself, ask questions, and I'd love this to be an interactive conversation. On that note, let me share my screen. Let me put that first. Okay. So again, as I said, this is kind of understanding the roles and responsibilities of general partners and limited partners and the differences thereof and some of the risks and rewards. So the first thing we'll talk about is roles in the partnership. So I think all of you guys may have seen Dallin's little opening video that he sent out, a part of this weekly reminder or invite, talking about, this is all geared around multifamily and syndications, and how taking down an apartment complex is a team sport, right? It takes general partners and limited partners to come in, and I'm going to explain the differences between the two. So as you'll see, general partners are also known as the sponsor or the syndicator in a deal. They're the ones that find the deal, vet the deal. They organize all the legal, the accounting, everything to take a deal down and bring that to their investor base or their limited partners, who are the capital raiser or the capital to be able to take this deal down. So one of the things that I really want to kind of highlight is on the general partner side is that of acquiring and managing the investment. So Dallin has had previous webinars, and we've got videos out there on YouTube if you want to dive into the deep details on what it takes to acquire a deal and manage a deal. But I just really want to highlight that from a general partner's perspective, it is running a business, folks, right? Being a general partner is very much active and very much a part of running and operating a full-blown business. It takes a lot of work and a lot of responsibility to make that happen. And from a limited partner's perspective, it's very passive, right? Their liability is less, which we'll get into a little bit more here in a minute, and their role is less, right? They're really just bringing capital to the deal with the expectation of a return. So as far as liabilities go, general partner, as I said, they're ultimately responsible for everything, right? They have unlimited liability. This means that if the property starts to go sideways or wrong, they're on the hook for it, right? They're the ones that have to face any legal, any type of debt or financing issues, anything that goes wrong in the syndication. They're the ones that are ultimately responsible for it. So this puts a lot of risk onto the general partners when going into a deal. They're the ones that have to make sure, vacancy is right, or is up, and the deal is running and operating correctly. But they also have to face anyone that may come after them for any reason. Where on the limited partner side, there's very limited risk there or limited liability. So, the amount of limited partners in a deal may may vary, but all of the limited partners sit in the same boat together, that they really don't have to worry about anyone coming after them if debts aren't being paid, or if there's a lawsuit that happens for some reason. So personally, it comes down to each of us individually, I guess I should say, on where our risk tolerance is and how we want to go about managing this business. The next piece I would like to cover is financial returns. So the differences here really is general partners will typically invest some of their own money into a deal. They don't have to, and they don't always, but typically in a syndication, you'll find that the general partner, they'll put skin in the game, as they say, which is good. And you kind of want to look out for that if you're coming in passively into a deal. Is the general partner putting skin in the game? Because if they are, then that means they have more to lose, and they're more likely to stay on top of managing an asset and seeing it to the end than they do if they don't have any skin in the game. So the majority of the financial return for a general partner is from the promote or carried interest, right? So this is anything above and beyond the preferred return that goes to the limited partners, and a share of the profit splits, right? So they also, I guess, make a portion of their income through fees. So this would be asset management fees, acquisition fees, disposition fees, refinance fees. There's a ton of different types of fees that can go in there, all of which help them to keep the lights on, right? So fees are important, and us, if you're coming in as a limited partner, have to recognize that they're operating a business, and it's important that they collect these fees in order to stay, sustainable as a business. From a limited partner perspective, most of their financial returns will come from the the preferred return in profit splits at the end, right? So anytime you're looking at a deal, it's very important to see, as a limited partner, to see how that deal is structured, because not every deal actually has a preferred return. And we're starting to see some shifts a little bit in the market on how some returns are actually handled. So it's very important that you read your subscription documents and PPMs and things when investing in a deal. And it's important to understand how those returns will come back to you as a limited partner. Now, the big thing between the two is, and I like to look at it this way, is, a general partner, they're putting less money in, but they're really getting more money out in the end, right? When you do a return on investment, they're going to have a higher percentage return on investment. But really, that's because they're doing all of the work, right, to make this thing happen. And they're taking on all of the risk, where limited partners are taking on less risk, and so therefore their return is more moderate. Let me pause for a minute. Does anybody have any questions up to this point? Any comments? I think everything I'm sharing is pretty much common knowledge, but we like to go through this just to make sure folks have a good understanding. And talent, Jim. Thanks, Justin. Appreciate that. So I found this little money tree image. I'm going to go off on a tangent for a second. I found this little money tree image, right? Because it's a good reminder of why we do this. Whether you're a general partner or want to be a general partner, or you're a limited partner, it's all about growing and preserving our wealth. And in either case, as a general partner or as a limited partner, that's what you're doing, right? You're trying to find an alternative means of income, especially as a passive investor, right? You hear it all the time. People are out there, preaching, literally out there on different platforms, social media and things like that, all about finding alternative streams of income and getting your money to work for you, because there's not enough hours in the day and enough energy in your body to be able to make the money that you really hoped to make in this life, to live financially free and do all the things that you want to do. So the best way to do that is to find alternative investments, which is, what we do here at REV, and why we have started our fund, to be able to do just that, to help people, grow and protect their wealth. So one of the big things here too, before I move on the financial returns, is it really is I don't know the actual difference. I don't want to say a 10x difference, but from a general partnership versus a limited partnership, you're really looking at a much larger return being a general partner. However, what I want people to really understand, if you haven't been a general partner before, and I'm going to say it again, I know I said it a couple of times already, it is a lot of work. It is a full-time, constant responsibility to be able to run a business. And that's exactly what being a general partner in a syndication is. You are running a business. You are managing all aspects of that business. So even though the returns look more enticing, right? They look better. They're like, oh man, I can 9x my money instead of 2x my money. Well, everything comes with a cost, right? So if you actually did the calculation on, time and effort versus from a GP versus an LP, to me, sometimes they kind of work out to be about the same. Next thing, this is really important also to understand the difference between a general partner and a limited partner. So when it comes to decision making, general partners have all the authority, right? There is very limited cases where a limited partner, the reason why it's called limited, can get in and make decisions. And usually those are only when someone is doing something illegal, meaning the general partner, right? Or they're running the business into the ground, and and they are blatantly and obviously not doing the right thing. Then the limited partners can come together and start making some decisions on replacing the manager, or AKA the general partner. So it's very important to know that when you go into a deal, a syndication or a fund, that as a limited partner, your decision making is limited. Now, a good general partner will want to inform their limited partners. So that's another aspect to be aware of. How does your general partner communicate with you? Are they having a monthly email coming out, maybe hosting a webinar once a month or something? Are they communicating the financials? Are they sharing all the details of how the deal is going? And before jumping into a deal with a general partner, those are important things to look at. How do they communicate? What do they communicate? How often are they communicating? And what's their past experience been? And can you reach out and talk to other limited partners that have invested with them before, in order to understand, and get some feedback from somebody that's been there and worked with them in the past. So decision making ultimately can be down to every little detail, the responsibility of the general partner. And from a running a business again standpoint, that's important, because you get too many hands in the cookie jar, and guess what happens? No decisions are being made. So it's set up that way on purpose, and it works best that way. But again, as a general partner, that means the success or the failure is ultimately up to you. And as a limited partner, it's I just like to say it's easy street, right? It's sitting on the beach and just having your money work for you. You don't have the responsibility there other than upfront making sure you're doing your due diligence and deciding on who you are going to partner with. And this brings me to risks and rewards. So from a risk factor, we've talked about a few of them already. You know, as a general partner, all the liability is on you, right? Threat of lawsuit, the deal going south, people not getting paid, returns not happening, the complex that you bought burns to the ground. All of that risk is ultimately on your shoulders. As a limited partner, much less risk. The biggest part of the risk is probably, again, at the beginning when you're doing your due diligence and making the initial decision of who you want to invest with. You know, doing what we like to do, which is first vet the operator, then the market, then the deal, right? We preach that all the time. First, the operator. Understand how they run their business, understand what that GP is doing, how they do it, why they do it, where they do it, looking at, you know, the market that they're doing that in, and, you know, is that a sound market? Also looking at the actual deal. Do the numbers make sense? Have you done your underwriting based off of their underwriting? Or did you actually get the financials and do your own version of the underwriting and get your sense of how that deal should operate before you invest? So now, I said this earlier too, from a rewards perspective, the GP is going to get, from a percent of return, a much higher number than the LP, right? Because they're taking on all the risk, they're taking on all the responsibility, so their return from a dollar invested perspective is going to be higher than the LP. But they're also taking on all the responsibility and all of the work, right? So they should get paid for that. Now, from an LP's perspective, you know, in today's market, we're seeing some of the returns start to slowly decrease, right? This 22 to 25% returns that we were getting just a year ago are slowly starting to retract and to level back out. Now, there's still great deals out there, great returns, and I think there's going to be more great deals out there. But things are getting a little more conservative as the unknowns of recession approach, right? And things are starting to slow down. I'm sure you guys all see that already. But when evaluating what you want to do here, and this is really what this is all about, this particular webinar. Do I want to be a general partner and take on all the risk and responsibility, build up and manage my own business, and take down these assets for the higher reward, which is, you know, a bigger payday at the end? Or do I want to be a limited partner and come in passively and take advantage of all the passive investment bonuses, less risk on my part, less work on my part, and still enjoy a nice return? Everyone has their own risk tolerance. Everyone has their own plan in life, right? It's ultimately up to you and your decision on where you want to go. And this webinar was just to try to give you some of that detail between what it takes to be a GP and what it takes to be an LP. So in summary, one thing that, you know, I want everyone to kind of take away from here is remember that the exact roles and responsibilities, the risk and rewards for a GP and an LP will vary based on the specific deal, right? The agreement of a syndication. So it's super, super important that you understand exactly how that deal is structured and all parties that are involved and who gets what and where and why when entering into any kind of investment, whether it's from a passive perspective or from a general partner perspective. So folks, I've that's it for me. I have shared everything that I was hoping to share today. I would love to turn it over to you guys if there's any comments or feedback or any experiences anybody would like to share. I don't know if we have, passive investors on here and what their experience have been like, or other general partners. Let's take a few minutes. I'd love to hear from you guys.
Hey, Jim, you did a great job, by the way. That was really good. The graphics and what have you. And pardon me for being the tax guy and the the outspoken. I always probably talk a little too much, but the underlying thing here for me is the difference in the tax treatment. Like everything you described is 100% directly or 100% correct, but it gives rise to different tax treatment too. So, and the one thing I always like to talk about when I talk about taxes with GPs and LPs, or the differences between, is that the LPs don't have any less tax benefits than the GPs do. Is the timing is different. And I always use myself as an example because I'm an LP in every deal that I go into. And there's been, and you mentioned that the market's changing, but in the last few years, I've had a few deals where I doubled my money and paid zero tax because of the tax benefits. So they're there. The GPs sometimes get the tax benefits on the front or on the beginning in the first year. The LPs will get it in the end. So it's all there. It's just a matter of timing.
Awesome. Thanks for that, Justin. Yeah, that's a really good point, right? Taxes are key to all of this, right? So I appreciate you throwing that out there. And the doubling the money perspective, right? How much work did you put in to double your money in a deal, Justin?
I was an LP. I did nothing.
Zero, right? Other than your due diligence, right? You have to do, folks. I'm going to say this over and over and over again. You have to do your due diligence up front. Don't just go, willy-nilly. Oh, I like that guy, and invest your money in a deal that he says is good, right? That's how people get burned. Believe me, that's how people get burned. So, thanks for that, Justin. Anybody else? So Hillary, thank you for throwing up the link to our YouTube channel. So guys, we record these every single week that we do them. We post them up on YouTube. Go back, check out some of the old topics if you're looking to catch up on some stuff. We cover all kinds of different aspects of real estate investing. If any of you have a desire to learn more, to really kind of dig in, please reach out to us. We're always here. We're always happy to help. Also, I just want to put a little plug in. I know we don't like to pitch deals and things like that, but we have started our fund for those who are looking to passively invest. Check it out. You can find perfect. Hillary's good at that too. She's put a link to our portal. You can go check out that deal that we've got open right now. But real estate investing, folks, is a awesome vehicle to grow and preserve your wealth. It just, hands down, it's been a stable, comparatively speaking to stocks and different things like that. It's much more stable, much more recession-proof vehicle to place your money, to let it grow, especially passively. It takes little to no effort to throw it in there and make it happen. So again, we're REV Equity Group. We're here. We love to educate. We love to help people grow and preserve their wealth. So connect with us. You can find links on our website to everybody on our team. Schedule a meeting with us. We'd be happy to jump on a call. And folks, thank you again for attending today, and we hope you enjoy the rest of your day and rest of your week. We'll talk to you next time.